The Supreme Court just killed the biggest tariff program in modern history. A 6-3 ruling struck down the IEPA tariffs on Friday, and within hours, the president signed a replacement. Stocks rallied, trade policy shifted, and the entire playbook for 2026 changed in a single afternoon. But that was only one piece of the puzzle. GDP missed badly. Inflation came in hot. The Fed started talking about raising rates again. All of that in a 4-day week. Here is what it all means for your money, where the rotation is heading, and the one earnings report next week that sets the tone for everything. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VIP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Let me walk through the biggest story of the week. On Friday, the Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not give the president authority to impose tariffs. Chief Justice Roberts wrote that when Congress grants tariff power, it does so with clear constraints, and it did neither here. This wiped out the Liberation Day reciprocal tariffs, the ones that hit some trading partners as high as 50% and China at 145%. Penn Wharton estimates up to $175 billion in tariff refunds could flow back to importers. The president moved fast. Within hours, he signed an executive order imposing a new 10% global tariff under Section 122 of the Trade Act of 1974. That has a 150-day time limit. China drops from 45% total duties to 35%. The EU falls from 15 to 10. Treasury Secretary Bessent said the replacement would produce virtually unchanged tariff revenue in 2026. For equity markets, this is a net positive. Lower tariff rates reduce import costs, supply chain pricing pressure eases, and businesses can finally plan with a simpler, more predictable trade structure. The S&P 500 rallied over 1% on a shortened week, closing at 6,909. Now underneath those tariff headlines, something bigger is happening. Ed Yardeni's research team calls it the Great Valuation Rotation. Capital is flowing away from the Magnificent Seven megacaps and into what Yardeni calls the impressive 493. Look at the numbers. A year ago, the Mag 7 traded at nearly 32 times forward earnings. Today, that is compressed to 25.8 times. Meanwhile, mid-cap stocks in the S&P 400 sit at 16.9 times. Small caps in the S&P 600 trade at 15.8 times. That valuation gap, combined with accelerating earnings for smaller companies, is the foundation of a rotation that may define this entire year. The year-to-date numbers tell the story. Small caps through the Russell 2000 are up 7.5%. The equal weight S&P 500 is up 6.54%. The NASDAQ 100, dominated by those mega-cap names, is actually down 0.9%. One 4-day week of large-cap outperformance does not reverse that trend. The VIX closed at 19.09, down 5.6% on Friday. That tells us the panic from the earlier AI-driven tech sell-off is easing. But volatility remains above the long-run average near 17. Markets are calmer, not complacent. Sector performance this week confirmed the risk-on mood. Communications led the pack, up 1.94%, boosted by Alphabet's recovery and strength in the advertising space after Omnicom's massive buyback announcement. Industrials gained 1.76% and are now up over 14% year-to-date. That trailing year return of 30.32% has real data behind it. The ISM Manufacturing PMI Production Index hit 55.9 in January. Manufacturing production growth firmed to 2.6% year-over-year. Industrial production rose 0.7% month-over-month, nearly doubling the estimate. On the bottom end, consumer staples dropped 1.81%. That makes sense. When the Supreme Court removes a major uncertainty like tariffs, money flows out of safe harbor sectors and back into economically sensitive names. Energy continued its standout year at 22.75% year-to-date. Supported by crude oil above $66 a barrel. The weekly leaderboard rewarded companies doing exactly what long-term owners want to see: returning cash, beating estimates, and investing in growth. RingCentral gained over 30% after reporting its first-ever dividend, expanding its buyback, and showing AI-powered products now generate over $100 million in annual recurring revenue. AI customer count jumped 44% in a single quarter. Omnicom surged over 20% after announcing a $5 billion share repurchase. That is 23% of its entire market cap being bought back. Global Payments jumped a similar amount, with $2.5 billion in buybacks, plus the WorldPay integration completing. Moderna gained 18% after the FDA reversed course and agreed to review its mRNA flu vaccine. The pattern here matters. This market is rewarding businesses that generate cash and allocate it well. Companies without those traits are getting zero benefit of the doubt. I was talking with a client recently about this exact dynamic. The companies that compound your wealth are the ones where management treats your money like their own. Friday morning delivered the kind of data that makes economists wince. GDP and inflation hit at the same time, and both carried bad news in opposite directions. Q4 GDP came in at just 1.4% annualized. The consensus expected 2.5 to 3%. That is a sharp drop from Q3's 4.4% pace. The Bureau of Economic Analysis estimated that the October-November government shutdown alone subtracted a full percentage point. At the same time, core PCE inflation jumped to 3% from 2.8%. That is the Fed's preferred measure, and it moved in the wrong direction. On a monthly basis, both headline and core climbed 0.4%, the fastest monthly pace since February of last year. Goods prices rose, services rose. Price pressures remain broad-based. Slowing growth plus rising inflation. That combination has a name, and it is not a pleasant one. But here is what the headline missed. Look beneath the GDP number. Private domestic demand still grew 2.4%. The manufacturing PMI production index hit 55.9. Capital goods orders reached record highs. Forward earnings for the S&P 500 are rising. Ed Yardeni calls the current economy a Nirvana state. Unemployment at 4.3%, CPI at 2.4% year over year. The misery index at 6.7, well below the 9.0 long-term average. That is about as close to the Fed's dual mandate as we have been in decades. The FOMC minutes from the January meeting dropped on Wednesday, and they carried a surprise. The committee voted 10-2 to hold rates at 3.50 to 3.75%. But several officials discussed the possibility of rate hikes if inflation stalls. That is the first time hikes have been on the table since the easing cycle began. The probability of a March rate cut collapsed to just 6%. The 10-year Treasury yield rose to around 4.10. A 20-year auction saw weak demand. Kevin Warsh, the nominee to replace Chair Powell when his term ends in May, wants to lower the federal funds rate, but pair it with aggressive balance sheet reduction. That combination is untested. His confirmation hearings will be a catalyst to watch. Globally, the tariff ruling sent trade officials scrambling. South Korea called an emergency meeting. Taiwan said the flat 10% rate would have limited impact on semiconductors. The EU, which had negotiated a 15% deal, now faces an even lower 10% rate. European markets rallied. The CAC 40 surged 1.39%. Goldman Sachs added LVMH to its European conviction buy list. Two risks worth flagging. Brent crude has climbed from $60 at the start of the year to above $70, driven by the increasing likelihood of a U.S. strike on Iranian nuclear facilities. And in private credit, Blue Owl Capital restricted withdrawals from one of its funds. The $1.8 trillion private credit market is showing liquidity stress. When credit funds gate redemptions, it rarely ends quietly. The value-aligned portfolio gained 0.75% for the 4-day week, trailing the S&P's 1.17%. Year-to-date, we are slightly behind. But the one-year numbers tell the real story. The portfolio has returned 16.92% net of fees over the trailing 12 months. The S&P returned 13.90%. Our top performers this week were LVMH, up over 7% on the Goldman upgrade and tariff relief. Medpace bounced 6% as biotech funding sentiment improved. Amazon gained 5.69% on reduced import costs and continued AWS demand. ASML added 4.48%, riding the AI capex wave with its monopoly in EUV lithography. That stock is up 37% year-to-date. On the challenges side, I want to be transparent. Novo Nordisk continues to digest its February guidance shock. GLP-1 pricing is compressing faster than expected. Accenture remains in the AI disruption crosshairs. AMD pulled back ahead of the NVIDIA report. These are company-specific headwinds, not a broken strategy. We are monitoring each one closely. I was on a call this week with a client who asked whether the short-term underperformance worried me. My answer was no. The businesses have not changed. Only the prices moved. Portfolios built around quality businesses across multiple sectors and geographies are positioned for exactly this rotation environment. The math favors patience. Here is what to watch next week. Monday, Home Depot reports, along with new home sales data. That gives us a direct read on housing and contractor activity. Tuesday is the big one. NVIDIA reports earnings. Blackwell platform demand, data center revenue, and forward guidance will set the tone for the entire AI infrastructure complex. Consumer confidence also drops Tuesday, along with Trump's address to Congress. Watch for tariff rhetoric and tax cut details. Thursday brings installed building products earnings and jobless claims. After this week's GDP miss, every data point will be parsed for signs of a Q1 bounce. 3 things to take from this week. 1. The tariff fog is lifting. A flat 10% global rate is far simpler and lower than the patchwork it replaces. This is a net positive for corporate earnings, consumer prices, and capital allocation decisions. Trade risk has not disappeared, but the worst-case scenarios are off the table. 2. The economy is stronger than the GDP number. The shutdown subtracted a full point. Private demand grew 2.4%. Manufacturing is recovering. Forward earnings are rising. The Citigroup Economic Surprise Index is running above 2025 levels. Yardeni calls it Nirvana. The headline told one story, the underlying data tell a different one. 3. The great rotation is real, and it matters. Mag 7 valuations compressed from 32 times to 25.8. Small and mid-cap stocks trade at a significant discount, with earnings finally accelerating. Portfolios built for breadth, not concentration, are positioned for exactly this environment. Stay disciplined. Own quality businesses. Let them compound. If you want a free review of your 401k choices, the link is in the description and the pinned comment below.